We've got futures this morning pointing to a slightly higher open, but of course, all the major averages are still near their record levels. So, what should you do now as an investor? Let's bring in Gabriela Santos. She's JPMorgan Asset Management Global Market Strategist. And Gabriela, I know one of the places you're looking, I'm going to start in a bit of an unusual place here. One of the places you're looking is outside of the United States. If we continue to see this sort of cyclical rotation, you say maybe you can get more bang for your buck by looking outside of the US. So walk us through your thinking on that.
That's right, Julie. So the US market is actually a very defensive market. Only one third of the S&P 500 is made up of so-called cyclical sectors, whereas international markets have over 50% of their exposure in cyclical markets. So when you have a cyclical recovery like we expect in 2021, it's really international's time to shine. And we saw this in November when we got that first little step of the cyclical rotation. International really outperformed the US by about 3 percentage points. We also expect to be able to get an added little boost from a weaker dollar, which we also expect to continue in 2021. So we think it's really important for investors to have a balance between US equity exposure and international exposure as well as we go into the year of the vaccine or 2021.
Gabriela, as part of that international call, what component, when you're out there, when you're modeling your expectations, what component reflects perhaps just lower trade tensions between the U.S. and Europe, between the U.S. and China, with President-elect Biden coming into power?
That is an important component, Brian. So it's the vaccine and the cyclical recovery, but it's also the outcome of the US election and a Biden administration, to us representing less uncertainty about foreign policy. And this is really important for countries and regions outside of the US, which are much more dependent on trade than we are, and which had been hindered by the trade war during 2018 and 2019. So this should be a more supportive environment for trade, for global growth. And this is also part of the reason why we expect a weaker dollar in 2021. So it's the combination of both of those things, the vaccine and the Biden administration.
Gabriela, I think the biggest debate right now happening in U.S. markets, at least, is valuations, what they mean, how important they are, the height of them, do they make sense? What kind of questions are you guys getting on that front, and how does that factor into the way you're thinking about markets next year? Certainly, it sounds like you find international markets more attractively priced, but do valuations scare you out of the U.S. at all?
So we have been getting a lot of questions. And when you just look at the forward next 12-month PE, it's at 22 times right now. It's some of the highest valuations we've seen since the tech bubble. So we do get a lot of questions around whether this is a bubble. And we say three things to that. The first is we're still looking at a next 12 months of some pretty strange earnings with the pandemic effect. If we look at valuations in 2022, a more normal year, then valuations come down a bit to about 18 and a half times. The second thing we say, it's also a relative game. So it's also comparing equities versus what you can get in fixed income, which has incredibly low yields, hence very expensive valuations in fixed income. So equities are still a bit better option. And the third thing we say is that it does, of course, take a little bit of a bite out of our return expectations for the next 10 years out of the US. We think we'll only be able to get about 4.1% annualized return out of the US. And that's why another reason why international is so important, because it does have a more reasonable valuation starting point. We do expect to be able to pick up between 200 and 300 basis point extra annualized return from developed and emerging international equity markets.
Gabriela, I wanted to ask you about another wrinkle sort of in trade and relations between various countries, which is the news that the House has just voted to approve a bill that would put some constraints on Chinese listed companies in the US, might even make it impossible for Chinese companies to list in the US. And I know you can't speak specifically to big companies like Alibaba that are listed here, but in general, what does that do to how you invest? I mean, for an institution like yours, presumably it's just as easy for you to invest in those stocks in Hong Kong or Beijing as it is to invest them in them in the US. But is there a bigger market effect?
I would say two things to that. The first is that to me, this is a symbol that being tough on China or competing with China is truly a bipartisan issue at this point. It's not just about the Trump administration. And it's really reflecting a change in sentiment here in the US and overseas. Populations now have a much more unfavorable opinion of China than they had just a year or two ago. So this competition with China will continue probably for the entire rest of our lifetimes. It's just that with the Biden administration, we can have a more predictable competition rather than unpredictable, which is what we've had for the past 2 or 3 years. But the competition remains. The second thing I would say in terms of investing in China directly, we still think it's one of the biggest growth opportunities of the next decade. So for us as investors, we don't have to choose between the US and China. We want to have both in our portfolios. And more to actually get that China exposure, we have to go directly to the source, as these companies are already dual listing in Hong Kong or in mainland China stocks in anticipation of this bill passing. So it's not a reason to completely give up on the China story. It's just that we have to be a bit smarter about it.
Okay, Gabriela, thank you so much. You're going to stick with us through the opening bell. Gabriela Santos of JPMorgan Asset Management.